Hello everyone. So far we have discussed the meaning and significance of cost of capital, different types of cost, that is historical and future, specific and composite, explicit and implicit, and then cost of debenture. Cost of debenture includes cost of irredeemable debenture and cost of redeemable debenture. In both we had another classification, that is before tax cost of capital and after tax cost of capital, right? We have also covered cost of preference capital. Cost of preference capital also classified into cost of irredeemable preference share capital and cost of redeemable preference share capital. Now we are going to discuss cost of equity share capital. The cost of equity refers to two separate concepts depending on the party involved. If you are the investor, the cost of equity is the rate of return required on an investment in equity. If you are the company, the cost of equity determines the required rate of return on a particular project or investment. So, cost of equity is the return a company requires for an investment or project, or the return an individual requires for an equity investment. In other words, cost of equity share capital is that part of cost of capital which is payable to equity shareholders. There are 6 methods available for calculation of cost of capital. First one, dividend yield method or dividend price ratio method. Second one, dividend yield plus growth in dividend method. Third one, earning yield method. And fourth one, earning yield plus growth method. And fifth one, realized yield method. And the last one, CAPM, that is capital asset pricing model. Let us have a look on the first method, that is dividend yield method or dividend price ratio method. This model is used to determine the cost of equity capital. Here, dividend plays an important part. According to dividend yield method or dividend price ratio method, cost of equity capital is the minimum rate which will be equal to the present value of future dividend per share with current price of a share. So the equation will be dividend per equity share by market price per share, that is DPS by MPS. You can simply written as D by M. Look at this problem. A company issues 1000 shares of rupees 100 each at a premium of 10%. The company has been paying 20% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. Compute the cost of equity capital, and will it make any difference if the market price of equity share is rupees 160? Here the equation is KE is equal to DPS by MPS. KE is equal to cost of equity, DPS dividend per share, and MPS market price per share. Dividend per share how much? That is 20%, that is given in the problem. So 20 divided by market price per share how much? See the problem, 100 each at a premium of 10%, right? So 110. So when we substitute the values in the equation, we will get 20 divided by 110 into 100. So the answer would be 18.18%. Then what will happen if the market price of equity share is rupees 160? So simple, 20 divided by 160. Here dividend 20 same and market price per share 160. So 20 divided by 160 into 100, 12.5%. Here you have to note that when market price increases, the value of cost of equity capital will decrease. Second method is dividend yield plus growth in dividend method. That is, dividend yield plus growth in dividend method is based on the assumption that company is growing, right? So its share market value is also increasing. In that situation, shareholders want more than simple dividend. Okay, so the company can provide some more profit according to its growth. So we will add it in the previous calculated cost of equity capital, right? So the equation will be cost of equity capital is equal to DPS by MPS plus rate of growth in dividend. You can simply written as K is equal to DPS by MPS plus growth rate percentage. Say this question, a company plans to issue 1000 new equity shares of rupees 100 each at par. The flotation costs are expected to be 5% of the share price. The company pays a dividend of rupees 10 per share initially and the growth in dividends is expected to be 5%. Compute the cost of new issue of equity shares. So, dividend how much? Rupees 10, right? And market price? See the question, the flotation costs are expected to be 5% of the share price. So, 100 minus 5. And here we have to add the growth rate. Here growth rate is 5%. When we apply the values in the equation, 10 divided by 100 minus 5 plus 5%, we will get 15.53%. There is one more question. If the current market price of equity share is rupees 150, calculate the cost of existing equity share capital. So the equation is same, DPS by MPS plus growth rate. So dividend is same here. No. So 10 rupees divided by market price per share, how much? 150. So 10 divided by 150 plus growth rate, that is 5%. So you will get 11.67%. With this information I am concluding. So far we have discussed the various methods of calculating cost of equity capital. That is, there are 6 methods available for the calculation of cost of equity share capital: dividend yield method or dividend price ratio method, dividend yield plus growth in dividend method, earning yield method, earning yield plus growth method, realized yield method, and CAPM, that is capital asset pricing model. From that we have covered 2 methods in detail. In the coming video I will explain the other methods also. Thank you for watching the video.